Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 May-June Paper 3-2 question number 2. This is the structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for this paper is 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. An accounts clerk of WPLC has prepared the draft statement of financial position and the draft statement of changes in equity for 2023. We have our draft statement of financial position at 31st December 2023. We have been given the non-current assets. The current assets includes inventory, trade receivables, cash and cash equivalents, which are correct. The equity includes ordinary share capital, and the nominal rate for our share is $1. We have the share premium and the retained earnings. Then we have 8% debenture for our non-current liabilities. The current liabilities include trade payables and other payables, which are also correct. Then we have the draft statement of changes in equity for the year ended 31st December 2023. We have the opening balance. The profit for the year is added to the retained earnings, which is the correct treatment. New issue has increased the share capital at the nominal rate as well as the share premium. Bonus issue has increased the share capital. This part is correct, but the bonus issue will never increase the share premium. So this part is incorrect. And this part is also incorrect because whatever amount of bonus issue increases the share capital should be deducted from the share premium. And in this case, we have a total of 32,000 plus 18,000, which is definitely greater than 40,000. It means that the total of the 40,000 can be deducted from the share premium itself in order to fund the bonus issue. That is the correct treatment. Then we have the dividend paid, which is subtracted from the retained earnings. That part is correct. Dividend proposed is also subtracted. This is incorrect because dividend proposed will not affect any of our financial statements. This will only be provided as a note to the accounts. We then have the revaluation of land. It's a positive amount, which means that this is a revaluation upwards, and whatever revaluation upwards we have should be included within the revaluation reserve, not the retained earnings. So this should be included as part of the revaluation reserve. Then the company accountant found that errors had been made in some items. Further information is available. Land and buildings with land costing 175,000 and buildings costing 80,000 were purchased on 1st January 2022. The company's policy was not to depreciate land or buildings. In March 2023, the land had been revalued upwards by 35,000. We have been given the draft statement of financial position for the year ended 31st December 2023, which means that the value of land is included after this revaluation upwards of 35,000. So the new value of land will be 175,000 plus the 35,000. This results in a value of 210,000. Then for the year ended 31st December 2023, the company decided to adopt the following new depreciation policy to be applied from the date of acquisition. And this land and building was acquired at the date of 1st January 2022. For the land, it is not to be depreciated. For buildings, it is to be depreciated at 2% on cost. The accounts clerk had not implemented the new depreciation policy. Since we need to implement this depreciation policy from the date of acquisition, this will relate to IAS 8, which deals with accounting policies, changes in accounting estimates and errors, and it also states that any new accounting policy should be applied retrospectively. It means that changes should be made to the previous years as well. In this case, the depreciation charge for the year will be the same, because we are following a straight line method. And depreciation is to be provided on buildings which has the cost of 80,000. So 80,000 times 2% will result in the value of 1,600. So this 1,600 should be the depreciation charge for 2022 as well as the depreciation charge for 2023. For the year 2022, that is our last year, which means that this value should now be adjusted to the opening balance of the retained earnings. It should be subtracted because depreciation is an expense, but we cannot create the statement of profit or loss for last year again, which is why we will adjust this amount to the opening balance of the retained earnings. So let us calculate the correct opening balance of retained earnings. We have the value of 151,000 here. Now we will deduct the 1600 as the depreciation charge for the year ended 31st December 2022. Then current year's depreciation charge of 1600 should be adjusted to the profit for this year. And depreciation is an expense, which means that now the profit should be deducted by 1600. Let's write it down. So the correct profit for the year, it's given right here. So we can start with the amount of 122,000, from which we need to deduct the 1600. This is the correct treatment, and this should also be adjusted to the non-current asset value within our statement of financial position, because previously no depreciation had been charged. Now we need to allow for last year's depreciation as well as the current year's depreciation. So this will give us the correct value of the non-current assets. Let's take a look at the second information. The following information is from the inventory records on 31st December 2023. We have three different categories, A, B, and C. We have been given the cost of the inventory, and we also have the estimated selling price. The accounts clerk had used the estimated selling price of 54,000 for the inventory value. To sell the inventory of each category, a sales commission of 5% on the selling price is required. Okay, since this talks about inventory, it relates to IAS 2, which states that the inventory should be valued at the lower of its cost and net realizable value. Net realizable value is the estimated selling price minus estimated selling cost. In this case, we have the selling cost as the sales commission, which is to be 5% of the selling price. So let us calculate the sales commission for each of these categories. For category A, that will be 45,000 times 5%, which results in 2,250. For category B, that will be 6,000 times 5%, which results in 300. For category C, that results in 3,000 times 5%, which is 150. Now we can calculate the net realizable value for each of these categories. That will be estimated selling price minus the sales commission. So for category A, that will be 45,000 minus 2,250, which results in 42,750. For category B, that will be 6,000 minus 300, which results in the value of 5,700. For category C, that will be 3,000 minus 150, which results in 2,850. Now, according to IAS 2, inventory should be valued at the lower of its cost and net realizable value. So we need to compare this column to our net realizable value, and we can get the correct inventory value. Okay. For category A, the cost is 30,500, whereas the net realizable value is 42,750. So we need to include it at the cost of 30,500 since that is lower. For category B, we have the cost of 5,900 and the net realizable value of 5,700. Clearly, the net realizable value is lower, so we will include it at the value of 5,700. For category C, we have the cost to be 3,800, whereas the net realizable value is 2,850. Clearly, this one is lower, so we will include the value of 2,850. Now, the correct inventory value will be 30,500 plus 5,700 plus 2,850, which results in 39,050. Okay, so let us correct it. Previously, the inventory had been valued at 54,000. Now, it should be included at 39,050. So we have the inventory overstated by 54,000 minus 39,050, which results in the value of 14,950. We also need to correct it within the profit for the year. Since we're talking about the closing inventory overstated should be subtracted from the profit for the year. Let's subtract 14,950. Alright, that is all for the second information. Now for the third one, on 1st March 2023, the company issued 60,000 ordinary shares of par value 1 at the price of 1.30 each. Alright, so for new issue, our ordinary shares, since the nominal rate is 1, will increase by 60,000 times 1, which is 60,000. And the share premium will increase by the excess value, which is 0.3 in this case. So 60,000 shares times 0.3. This results in a value of 18,000. At the same time, a bonus issue was made of 1 for 10 shares held immediately before that date. The accounts clerk had used the issue price to record the bonus issue. So we've already corrected it before. Bonus issue will not have any sort of share premium, only the nominal rate will be included at 40,000, and the correct treatment is that 40,000 should now also be subtracted from the share premium. Alright, then for the fourth information, accrued debenture interest of 2,000 was included in the value of 8% debenture. Okay, so the debenture amount is incorrect. Instead of 52,000, it should have been 50,000. And the 2,000 should be included within other payables because that is the accrued interest which is yet to be paid at the date of 31st December 2023. For the fifth one, other payables of 63,000 included the proposed dividend of 42,500. Like I said before, proposed dividend will not be included within any of our financial statements. It will only be shown as a note to the accounts. So we now need to remove it from the other payables. So let us subtract the 42,500. Okay, that is all for the additional information. Let's take a look at our first question. We need to explain how to correct the errors made by the accounts clerk in relation to depreciation on buildings and valuation of inventory. We need to support our answer with calculations and with reference to the relevant international accounting standards. Use this piece provided to show your workings. Okay. We'll talk about depreciation on buildings first. Like I said before, this relates to IAS 8 because there is a new accounting policy being introduced. Let's write down the IAS first. So IAS 8 is for accounting policies. Changes in accounting estimates. And errors. So IAS 8 states that a new accounting policy should be applied retrospectively and in this case a new accounting policy relating to the depreciation of buildings was introduced, and the depreciation charge for last year will be 1,600, which should be adjusted to the opening retained earnings and should be subtracted from the non-current assets value, and the depreciation charge for the current year should be deducted from profit for the year as well as the non-current assets. Let's write it down. We can also show the depreciation charge calculation. So depreciation for the year will be 80,000 times 2%, which is 1,600. So the depreciation charge for 2022, which is 1,600, should be deducted from the opening retained earnings. And the value of non-current assets. Then the depreciation charge for 2023, which is again 1,600, should be deducted from the profit for the year. And the value of non-current assets. That will be all for depreciation on buildings. Let's move towards the next part. We now need to talk about the valuation of inventory. Like I said before, anything related to inventory will be for IAS 2. Let's write it down. It deals with inventories. So IS2 states that inventory should be valued at the lower of cost and net realizable value. And net realizable value is the difference between estimated selling price and estimated selling cost. So we've already calculated the correct value of the inventory to be 39,050, which is to be included within the statement of financial position. And we've also concluded that the inventory value is overstated by 14,090, which is to be adjusted to the profit for the year. Let's write it down. The correct value of inventory is 39,050, which should be included in the statement of financial position. Inventory had been overstated by 14,950, which should be deducted from the profit for the year. That is all for the second part. Let's move towards the next question. And we have been given the working sections, so you need to show all of the workings that I did in the insert within this particular box so that you get your markings correctly. For the second part, we need to prepare the corrected statement of changes in equity for the year ended 31st December 2023. And a total column is not required. Okay, so we'll have the retained earnings. We have the revaluation reserve because we had revaluation upwards. We have the share premium and the share capital. Okay, we can start with the opening balance. So at the date of 1st January 2023, the values were given above. Okay, we can include the share capital at 400,000, share premium at 32,000. We did not have any revaluation reserve at the start of the year, so that will be 0. And the correct balance for the retained earnings at the opening date will be 151,000 minus 1,600, which is also 149,400. Let's write it down. So the share capital is 400,000. Share premium is 32,000. We do not have any revaluation reserve, and the retained earnings is 149,400. Okay, then we had the new issue, which was correctly included before, and we've also calculated the correct values. So that will be 60,000 for ordinary share capital, 18,000 for the share premium. So 60,000 here, 18,000 here, and we do not have the total column. Then we also had the bonus issue, and for the bonus issue we've already concluded that only 40,000 will be included within the share capital, and the same 40,000 is to be deducted from the share premium. Let's write it down. So 40,000 should be added to share capital and 40,000 should be deducted from the share premium. Then we have the dividend paid. So the dividend paid will be included at 60,000 and it will be subtracted from the retained earnings. So 60,000 subtracted from the retained earnings, and no other column will be affected. We also have the revaluation of land. And it was increased by 35,000, so the revaluation reserve will also be increased by 35,000. Then we can include profit for the year. We have to include the correct value. And we have already included the calculation for the correct value right here. So that will be 122,000 minus 1,600 minus 14,950, which results in the value of 105,450. Let's write it down. And this should be added to the retained earnings column. So 105,450. That will be all for our statement of changes in equity. So now we can calculate the closing balances at 31st December 2023. For the share capital, that will be 400,000 plus 60,000 plus 40,000, which results in 500,000. For share premium, that will be 32,000 plus 18,000 minus 40,000, which results in 10,000. For revaluation reserve, that will be 35,000. For retained earnings, that will be 149,400 minus 60,000 plus 105,450, which results in 194,850. That is all for the second part. Let's move towards the third one. We now need to prepare the corrected statement of financial position at 31st December 2023. Okay, so this one is corrected. Statement of financial position. And this is at 31st December 2023. We can start with the non-current assets. And we've already included the calculations to be made in order to get the correct value of the non-current assets. So that will be 642,000 minus 1,600 minus 1,600, which results in 638,800. Let's write it down. We can then move towards the current assets section, which included inventory, trade receivables, and cash and cash equivalents. We've already calculated the correct value of inventory to be included. That is 39,050. We include the trade receivables at 226,000 and cash and cash equivalents at 60,500. So inventory is 39,050, trade receivables is 226,000, and cash and cash equivalents is 60,500. So the total of the current assets will be 39,050 plus 226,000 plus 60,500, which results in 325,550. Then we can calculate the total assets, which will be 638,800 plus 325,550, which results in 964,350. Then we can start with the equity. For equity, we have 4 different items. We have the ordinary shares, we have the share premium, we have revaluation reserve, as well as the retained earnings. And we'll include the correct value from our corrected statement of changes in equity: 500,000, 10,000, 35,000, 194,850. So 500,000, 10,000, 35,000, 194,850. The total equity will be 500,000 plus 10,000 plus 35,000 plus 194,850, which results in 739,850. Alright, then we can move towards the non-current liabilities. We only have one non-current liability, which is the 8% debenture. And we have calculated the correct value for debenture as well. Right here, it's supposed to be 50,000. We can then move towards the current liabilities section, which includes trade payables and other payables. Okay, for the trade payables, I don't think there were any changes to be made. We can include it at the given value of 152,000, whereas for other payables, we have the correct calculations right here. That will be 63,000 plus 2,000 minus 42,500, which results in 22,500. Let's include these two. So that will be 152,000 and 22,500. The total current liabilities will be 152,000 plus 22,500, which results in 174,500. Now we can get the value for total equity and liabilities. That will be 739,850 plus 50,000 plus 174,500, which results in 964,350. And in this case, the total asset value is equal to the total equity and liabilities, which means that our statement of financial position is correct. That is all for this question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.